Hi, this is Andy Hoffman, Media Director for Miles Franklin Precious Metals in our 25th year of business. It's midday, Thursday, July 3rd, and today's audio blog is called Cartel Wars, The Return of Gold and Silver. Today's title clearly refers to the gargantuan battle being fought for control of the world's reserve currency as a concerted three-year effort to suppress thousands of years of cumulative monetary history appears to be nearing its end. Western precious metals demand may have been temporarily quelled by a combination of vicious naked shorting, the distorting of whatever central bank gold still remained, ask the Germans, and the propping of stock and bond markets with overt and covert money printing. However, Eastern demand has never been stronger, production is rapidly declining, and the realization that fiat currencies are being eaten alive by inflation is rapidly sweeping the planet. This is why the de-dollarization movement led by China and Russia is taking off right now, and believe me, it's not going backwards. This week's, quote, surprisingly strong precious metals action was no doubt shocking to the cartel, which figured it could have its way with the supposedly, quote, overbought conditions it created through vicious naked shorting amidst a holiday-shortened week featuring one of the most important key attack events imaginable. That is the NFP employment report issued in ultra-thin pre-holiday conditions. The report turned out to be as fraudulent and blatantly transparent as recent BLS propaganda, and thus the odds that the triple bottoms created at $1,200 gold and $19 silver over the past 12 months will likely kickstart the next bull phase are increasing with each passing day. Either way, we cannot emphasize more that gold and silver are not investments, as the evil troika of Wall Street, Washington, and the mainstream media will have you believe, but long-term savings that have protected assets against the inevitable fiat currency collapses for millennia. Now, just to go through a whole bunch of stuff for this week, because really it's been a mishmash of news, and as usual, the horrible headlines have been precious metals favorable and stock and bond negative. Well, let's start with Monday here in the States. The Chicago PMI down 65 from 65 to 62. Then you had on the Tuesday the ISM manufacturing PMI. You know, the one that last month was changed twice within an hour because they put the wrong seasonal adjustment on yes and no questions. That came in line in the mid-50s, as did the PMI in the mid-50s. However, highlighting what we have been focusing on all quarter here at the Miles Franklin blog, construction spending, that is an actual real piece of data, was up a measly 0.1%. Just as we were baffled at last quarter's assertion that minus 3% GDP growth was somehow due to the weather versus last year's plus 3% GDP growth in the first quarter, and we proved otherwise in an article called Mother Nature Has Had Enough, we're equally baffled at how this quarter Wall Street estimates 3% or so second quarter GDP. Now again, these numbers are all meaningless to start with. Remember, the Fed just makes up what the definition of GDP is. They've added a whole bunch of things that aren't even, that don't even produce actual earnings to the economy. And at the same time, they used a record low GDP deflator in the first quarter, or else it would have been a lot lower. Can you imagine? The BLS foodstuffs index was up 20% in the first quarter, and yet they used a record low GDP deflator. And energy prices, I think, were up 9%. So forget the fact that these numbers are BS to start with. I don't understand where they are coming up with this plus 3% GDP growth estimate for the second quarter. Because I put a chart in a day or two ago into one of my articles showing durable goods flat for the first 2 months of the quarter, even ex-transportation, factory orders, construction spending, industrial production, industrial manufacturing, retail sales, including ex-autos and gas, consumer spending and mortgage purchase applications, and of course the labor participation rate, which is sat all quarter at a 35-year low. There's not a single piece of data that indicates anything more than flat growth from first quarter to second quarter, and yet we're told that we should expect plus 3% GDP. Not only that, the other things that they kind of look at, Wall Street looks at to make adjustments like trade deficits, have all gone in the wrong direction. So please, pray tell, how are we getting to 3% GDP growth, weather or otherwise? Okay, yesterday, Wednesday, the ADP report up 280,000 jobs versus the 210,000 estimate. But for one, it's always, not it was yesterday, it's always seasonally adjusted. We have never ever seen actual data from an ADP report. And in fact, I can't emphasize enough, it wasn't until maybe 2 years ago when the economy really started tanking that anyone even looked at this ADP report. It's so hopelessly out of sync with reality. It's seasonally adjusted. Remember, I think it was a year ago where they restated the prior year's jobs down for like 12 or 16 months in a row. So there's no reliability in it at all. It's just become yet another data point. We've seen an explosion of data points from the powers that be, or key, what I would call key attack events. Ways to prove that stocks should be bought and gold should be hit. Like this incredible amount of PMI indices coming out. Some of them created by private organizations. Some of them that are being paid by traders beforehand to see the information. Just an endless amount of arbitrary, meaningless, statistically insignificant data, which can be manipulated at will, as opposed to durable goods, factory spending, industrial production, which are real numbers, and none of them are saying anything other than stagnation at best. Now, anyway, of this 280,000 ADP jobs, again, seasonally adjusted, as Zero Hedge would put it, they've been goal-seeking, clearly goal-seeking, because for so many years, their numbers have been completely and utterly out of sync with the NFP, making the ADP numbers even more unreliable. I mean, how many times have we seen the ADP number be horrible, quotes around it, because they're all lies anyway, and then the NFP being great, or vice versa? So clearly, starting with those revisions of the numbers, they've clearly been on a course of desperately trying to match what the NFP report puts out, which in itself is the most fraudulent number of all time with its birth death model and all that stuff. And clearly they finally did it. They got the number to finally be in line with the NFP. Well, congratulations to them. The amazing thing was that the same day the ADP came out yesterday, a Gallup survey came out saying that private jobs in the economy were down last month, and government hiring was at the highest levels since the survey commenced in 2008. So in other words, as usual, the ADP report was noise at best and fraud at worst. And of course, while that was coming in, while that was published, May factory orders came in down 0.5% for the month. Unexpected to Wall Street. Okay, and now today, this morning, 288,000 jobs with the NFP report, just like 2 months ago. If you remember, I forgot the name of my article that day. It was like three numbers: 288,000, 250,000, and minus 808, which was the number of jobs, the number of birth death jobs, and the number of people that left the labor force that month. And that number was that report was completely called out by Wall Street. They didn't believe it at all. In fact, I don't think anyone believes these numbers anymore with the BLS, especially the unemployment rate. And again, eerily right near where the ADP number was for the first time that I can ever remember. Now, of these 288,000 jobs, just 26,000 were goods producing, and the other 260,000, of course, were service producing, with the majority being in health, education, and food service, or as they call it now, waiters and bartenders. And 121,000 were birth death model jobs, so they weren't real jobs. But the best part of it all, and by the way, I'm sure once we see the data, you'll see that almost all those jobs are in the 55 plus age category, where people are delaying retirement because they desperately need jobs at Walmart and McDonald's to pay the bills, care of having no savings, and a Fed intent on keeping interest rates at zero, so they can't make any money on what savings they do have. But the best part of it was, it turns out that of these 288,000 jobs, a record 799,000 part-time jobs were supposedly created last month, while 523,000 full-time jobs were eliminated, which is exactly what the Gallup survey said. Now, there's nothing new about this ugly trend. It's been going on for some time, and forever we have wondered why the BLS considers a temp and a part-time job to be the equivalent of a full-time job. Last time I looked, if you make half the money and work half the hours, that should be considered half a job. But no, in this world of having algorithms control markets and and the media just putting it out headline propaganda. I mean, they might as well say if someone works for an hour a week delivering newspapers, that counts the same amount as a full-time manufacturing job, of which very few still exist. I think I read the other day that as little as 15 years ago, 20-something% of U.S. jobs were manufacturing. Now it's like 8% and declining. Better yet, the quote unemployment rate unexpectedly plunged another 0.2% to a 6-year low of 6.1%. Yet another 92,000 people left the workforce, yielding another 35-year low labor participation rate. So again, anyone who believes that there's even a shred of truth in these reports, let alone of anything that's remotely positive, is beyond me. I think we're, again, there's three legs of the powers that be's remaining tripod. There's propaganda, market manipulation, and money printing. And as far as I'm concerned, the propaganda leg is dying, because I don't think anyone anymore believes in this mythical recovery. Especially, I mean, look, we're 6 years into it. Okay, according to history of the United States, 6 years would be a long expansion. I mean, you typically have a recession after 6 years. We're still in the phase where the government says we're still recovering, and we haven't even come close to an expansion. So, I don't think anyone believes it. And when you look around what's going around the world, I mean, today you had Komatsu, the second largest earth-moving equipment company, saying that its Chinese orders are going to be well below the 20% decline that they were anticipating. And Caterpillar 2 weeks ago saying its Asian sales are down 30%. And today alone you had weak manufacturing data in China, Japan, Australia, and the European Union or Eurozone. So why anyone believes that? I mean, in fact, today's article I wrote is called Island of Lies. Somehow the only place on the earth where anything quote positive is going on is in the U.S. labor market, where the numbers are clearly rigged, and the U.S. diffusion indices, which are clearly rigged. There's not a single shred of anything else anywhere that's positive. And then you throw in the geopolitical risks going on, the surging energy and food prices, the de-dollarization movement, all this stuff going on with China and Russia, the fact that the gold doesn't exist, the London fix is under scrutiny, the Germans can't get their gold back, et cetera, et cetera. And we're supposed to really believe that there's something good going on that needs to that should cause stocks to trade at higher valuations than we've seen in 2000 and 2007, and bonds, by the way. Stocks, bonds, real estate, well, only high-end real estate, of course, because, the 99% real estate is not going up. But we're talking about, as we've been writing for some time, the greatest disconnect in the history of markets and economies. And, I wrote a piece a few weeks ago called Place Your Bets, Wall Street versus Economic Mother Nature. I'm pretty sure you know who's going to win that. On that note, Whirlybird Janet gave a speech yesterday saying, quote, increased risk-taking in corporate bonds, leverage lending could cause future problems and needs monitoring. Okay, it needs monitoring, these record high valuations utilizing fraudulent non-GAAP accounting, record low treasury investment grade and junk yields amidst an environment of record high debt and inflation and generationally weak economic activity coupled with widespread social unrest. Not to mention when such positions are held on record leverage supplemented further by off-balance sheet derivatives and shadow banking loans. Or how about every penny, and I kid you not, every penny of Wall Street earnings, much of it of the non-cash nature, and thus supplemented by new borrowings, have been used for dividends and stock buybacks for the past 5 years. Talk about moral hazard and neglected fiduciary duty. As the newest corporate cancer, quote, activist shareholders destroy America, happily accommodated by managements incentivized entirely by stock prices and not their company's futures, which of course is an offshoot of the Fed and PPT shooting liquidity into financial markets. And now that we learned that governments own half of all the global equities and probably at least half of all the bonds, who are they left to sell to? And will they soon take over the entire corporate world and destroy it like everything else? I mean, this is what communism is. When you own half the stocks, you own half the voting power, and thus governments will be owning the means of production. Something's got to give. And as I mentioned earlier in Wall Street versus Economic Mother Nature, I'm pretty sure what's going to give. A couple of miscellaneous notes. Argentina on the verge of default. Care of this of all people, the Supreme Court of the United States ruling that Argentina is not allowed to pay back debt until it first pays back the U.S. hedge funds it borrowed from first. Better yet, Puerto Rico, if you remember, just 4 months ago, shoved Wall Street, led by I think Morgan Stanley, shoved a $4 billion bond offering down investors' throats. Well, just 4 months later, Moody's just downgraded 3 notches further into junk status, and they may well default on their entire $70 billion of debt. And because it's a U.S. Commonwealth, there's been serious debate as to whether the U.S. government should backstop this. But what's another $70 billion of debt here and there? And then, of course, you have, I'm trying to even get my hands around this because I saw this yesterday. We have long written here about how India is perhaps the worst managed country on the planet, and which is pretty dangerous since it has 1.5 billion people, many of them just about to start at the poverty level. They have gone out of their way to try to keep gold and silver demand down and failed miserably, because last year, even with those tariffs, you had record silver imports, and the gold imports, who knows what they were, because the black market exploded, and so did the premiums over the paper prices. Well, it turns out, I'm reading today, that even though next week they are likely to be reducing those tariffs and maybe even repealing them entirely, the Reserve Bank of India is actually considering swapping their gold, which is not an international standard form, with probably with like the Bank of England or the Fed, so they can get international standard gold that they can sell into their own market. They say, well, we want to diversify and manage our reserves, and they'll have, of course, more rupees with that. But we'll keep the gold in the country by selling it to the country. So yes, so the people of India may have some more gold, but something tells me it's going to be the Chinese that actually swoop it up. But the India, which spent so much time and effort outbidding the Chinese for 200 tons of gold last year, 5 years ago, now wants to apparently sell it all. Which is insane. And no, don't worry, it's not going to take the price down. Remember that IMF gold 5 years ago that it was held over our heads forever? Oh, the IMF's going to sell their gold. It's going to crush gold prices. Well, it never did. It eventually got swooped up by India, of all people, and the price surged thereafter. And by the way, if they do wind up selling this, I can assure you it'll go in 2 seconds. And again, making India even more prone to the ultimate currency collapses that are coming. Well, as for markets, record low on the VIX today. Stock markets hyperinflating, just like almost at a Venezuela, Zimbabwe level. It's coming soon. And gold and silver extremely resilient following their post FOMC surge 2 weeks ago. The capping has been incredible in the past couple of weeks. But silver, which I wrote about 2 days ago, calling it the world's cheapest asset, is very, very strong, above 21. Gold is hanging in there at 1320. Both are well above their 200-day moving averages. And the litany of horrible headlines is not going to go away anytime soon. Remember, for what it's worth, Jim Sinclair 2 weeks ago said he believes that we're going to see $2,000 gold by the end of this year. I'm not saying that's going to happen. I'm just saying if even that scenario is possible, we're talking about you better start thinking of protecting yourself, because it will be a very ugly world by year end. Well, that's enough for today. Hopefully you're starting to realize the reality of the world is far different than what the money printing, market manipulation, and propaganda scheme of the powers that be are trying to tell you. The chinks in the armor are showing everywhere, and it's only a matter of time before this fiat Ponzi scheme, like all the others before it, collapses. This is why you need to consider protecting your net worth now while there's still a chance. And if you do, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, you can contact me with any questions you might have at ahoffman@milesfranklin.com. Thanks, and have a great holiday weekend.